What is going on, traders? So September was the worst month of 2023 as suspected. If you've been following this channel, you know that I thought August and September would actually be red months. And not only was September a red month, it was actually the worst month this year for the S&P 500. But the S&P 500 fell almost 5% in September. So in this video, we're going to recap just what went on in September and why we could see a capitulation event in October, but also a bottoming out for stocks in October to round off the year. Also, if you guys want me to bring back the top stocks to buy list, I used to do these lists at the end of every month. The top stocks that I'm looking at, even if I'm not buying them in droves, but the top stocks that I'm looking at, why I'm looking at them, leave a comment down below, let me know, and hit a thumbs up, and let's get right into it. So as I said, in September, the stock market had the worst month of 2023. Not only did I short the SPY, we shorted it using a credit call spread for 100%, but we also closed out our Apple short for 40% profit. So we shorted Apple and we shorted the S&P 500. And I took out a new short on the S&P 500. That one is currently up 32% as of the time of this recording. And here's why I'm going to continue to hold it in October until this happens. So just like I told you that August and September were usually red months, October is known as the month where stocks bottom out when we are facing circumstances like the ones we are currently facing, where we see a rally in the S&P 500 from January to July. However, this doesn't come without short-term consequences because in October, we do tend to see big drawdowns and a bottoming out. How do we measure this? Well, we have a measure that technical analysts use that basically takes the difference of the VIX and the VIX 3M. The VIX 3M, the only difference is the VIX 3M is the VIX, but it measures volatility in options that expire in 3 months or precisely 93 days until expiration, whereas the VIX is only correlated with options that expire within the next 30 days. Now, when this measure is below 1, especially when we are at a major support level in the S&P 500, that tends to signify market bottom. So I know that this is very specific, but even if we don't take that measure into account and we just take a look at the S&P 500, as I said, this head and shoulders, it's funny to me how there were a few people that were arguing that this is not a head and shoulders, and they were saying the right shoulder is too high, that you don't know what you're talking about. Well, it's a head and shoulders, and we did break below it and confirm it. So I don't know what to tell you. But this push up into the neckline of the head and shoulders and this huge rejection from it, this right here does not instill confidence that we are ready to move up beyond the head and shoulders. Also, if you measure from the head until the neckline, we're about 4.3%. So we expect there to be a similar drop from the neckline below if we are, as a matter of fact, going to confirm this head and shoulders in the classical sense, right? So that would take us to the 4,100 to 4,200 level on the SPX. So I do think we'll see a little bit more seasonal weakness until at least Friday the 13th when we enter unofficial earnings season or official earnings season, depending on who you ask. That is why I'm going to continue holding these shorts. And by the way, if you want access to all of our short plays, if you want access to all of our day trades, our other two analysts are mainly focused on futures. We had a fire futures trade for over $2,000 a contract today on the NASDAQ futures. So we are not only focusing on options and short plays, and I also send out my cash secure put ideas and my stock buys as well in this channel. If you want access to all of that, click the link in the description. If there's a promo code, then you're in luck. Use that promo code, take advantage of it. In my view, we are the most versatile, profitable group online. So make sure that you come and join us. Now, I do think that regardless of what happens, whether we get further downside or not, I do think that stocks are going to end the year strong, barring obviously a credit event, which we will talk about, because I do think that we are on the verge of a credit event. Here's the thing with credit events, though. They are impossible to time and they're impossible to predict. So I don't think the credit event is going to be in something like housing because I don't think there is a risk in housing. The risk in housing is still the fact that there is limited supply, right? Like if most people who own a house have a very favorable interest rate, well, they're not going to be selling their house to then get into another mortgage at 8%. So I don't think that there is a huge risk in housing the way that we saw in 2008. But the more resilient the economy is, the more that the Fed will have to keep the rates higher for longer, as we've talked about on this channel when covering FOMC. And as I stated on Twitter, by the way, make sure that you follow me on Twitter and Instagram for free daily trading finance content. Since 1955, the recession is the only thing that successfully brought down inflation to the Fed's target. That is it. There's never been another case. So right now, with unemployment resilient still at below 4, with bond yields inverse to hell, like I cannot believe that the 10-year and 2-year is still inverse like this. Although the curve is steepening, it is still heavily inverted. So now one could make the argument that that credit event would have been the banks, right? The bank failures. However, the Fed and the Treasury came in and really backstopped any losses that the FDIC would have suffered, that the banks would have suffered. So, once again, the Fed came in injecting liquidity. So you could make the case that that was a credit event, but the longer they keep these rates up, something else will crack. I just don't know what that is. However, the Cleveland Fed chief came out today and said that they're going to have to raise rates one more time, which I believe will happen either on November 1st or December 1st. I think the Fed is going to raise rates one more time. And she says it's specifically because of rising gas prices. Now, this is absolutely insane because it seems like the U.S. should have control a little bit over what happens with gas prices. But the fact that Saudi cut production, the fact that Russia cut production, it doesn't seem like we have any sort of answers to come up with on our own. And it looks like, for all intents and purposes, despite the small pullback in oil, that oil is likely headed for the triple digits at over $100 a gallon. I might actually have a play on oil futures with that said. But as you can see here, most of the Fed governors, 12 of the Fed governors and regional bank presidents, predict one more rate hike in 2023. As opposed to 7 seeing no further action. So most of them support another rate hike, and I think that is what we are going to get. Also remember that the U.S. government has debts to pay, right? When they issue treasuries at these high interest rates. So right now, if you look at the treasury yields, they are insane. And it actually is looking like a very attractive investment, right? The 1 month, 2 month, 3 month, 4 month, 6 month, 1 year are all up over 5.5% or around 5.5%. That is insane that you could still get these yields, right? But who is paying these yields? Because it is the Fed that is issuing these treasuries and issuing these loans out to you guys in exchange for your dollars. So they're going to have to pay you back these yields. And the longer that interest rates stay high, the bulkier their interest payments are going to be. The U.S. is paying a record amount of interest in its national debt, and this was posted a month and a half ago. Now it's even more. But interest rates on the national debt will hit $5.4 trillion by 2053. That is crazy. So I think for that reason, really the government is praying for a recession as soon as possible because, like I said, a recession was the only thing that was ever successful since 1955 at bringing down inflation to the Fed's target. And here you could see every single time we had inflation, the blue is the CPI and the red is core CPI. But you can see that for inflation to drop, we've had to hit these gray bars. These gray bars here are the recessions. That is the only thing that brings inflation down at the end of the day. So yes, inflation right now is hovering just under 4%. But remember, it climbed back up. We flattened out at 3, and now it's back near 4. And it could take years for it to get back down to 2. So I guess in summary, what I'm saying is that I do expect there to be crazy volatility in October, but I do think stocks will bottom out in October, and I do think we will get an end of the year rally. Now, I can't predict a credit event. So this is obviously barring a credit event. I do think we will get a credit event if rates are not cut through next year. I do believe something will break. I do believe the Fed is going to hike one more time this year, and then that will be it. Although they cannot say that will be it, they're still going to say, we have to weigh our options. We're going to wait and see. They're going to have to talk their shit, et cetera, et cetera. But I think that will be the final rate hike, and then they just keep them there for as long as it takes for inflation to come down. I think something will crack if they don't cut soon into 2024. And in 2024, I do think we will hit a recession, whether it's a mild recession or a heavy recession, like a deep recession. I don't know. It really depends on what the credit event is, in my opinion. But I do think we will hit a recession in 2024. You'll finally start to see unemployment tick up. And that is when you'll start to see oil prices drop, etc. But I am making some strategic buys right now. I am planning on selling some cash secure puts soon as well. Like I said, I do have strategic shorts in the market, and I am going to be playing commodities such as oil, treasuries, and maybe even gold at this point, because gold is absolutely tanking in conjunction with the dollar rising like crazy. And gold is about to hit a death cross, by the way. So if you want all of my plays, link is in the description below. It will cost you less than $4 a day. Would love to have you. And if you become the trader that you want to be, I'm sure you'll be able to make more than $4 a day with your trading, hopefully. Anyway, traders, leave a thumbs up, leave it in the comment section below. Let me know if you want a top stocks, if you want me to return with the top stocks video series. Let me know in the comment section below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.